What if I told you that a company can shatter box office records while its stock is mathematically engineered to drain your portfolio? Hey everyone, Smart Stock Sam here, and today we're diving deep into why AMC's trading range refuses to break and why that might be the least of your worries. If you've been watching AMC bounce between the same price levels, wondering when the breakout happens, stick around, because what I'm about to show you explains exactly why that range is stuck and what's really happening behind the curtain. Let's start with the numbers that Wall Street doesn't want you focusing on. AMC is down 65.7% from its 52-week high, trading around 138. Now, you might see that RSI screaming oversold and think bargain opportunity, right? But here's where it gets interesting. We're witnessing a volume price divergence that's completely negative. Volume is climbing while price is falling. What does that tell us? Bid depth is being systematically drained. Every buying wave gets absorbed, and AMC has quietly shifted from a momentum stock into what analysts call a distressed debt recovery play. The range isn't breaking because there's a ceiling being enforced by market mechanics, not just resistance levels. But here's the controversial part that nobody's talking about. There's a dilution engine running 24/7 in the background, and it's management pulling the lever. Picture a funnel. On one end, you've got retail traders piling in with fresh capital and enthusiasm. On the other end, management is executing $150 million at the market offering, slowly releasing new shares into circulation. The stated purpose? Generating liquidity for debt service. The reality? Retail demand is being converted into exit liquidity for the company's creditors. Every share you buy helps pay down someone else's debt, not build your equity value. Now, this next piece changes everything, and it's hiding in the capital structure. We're seeing what I call a capital stack inversion. Institutional lenders who are trapped holding AMC's unpayable debt are converting $143 million of that debt into equity. They're essentially taking the keys to the company to ensure they get paid first. And where does that leave common shareholders like you and me? Dead last, subordinated. You're at the very bottom of the recovery waterfall, meaning if this ship ever does sink, you're the last one getting a life raft. But Sam, you might be asking, if the stock is so broken, why are the movies crushing it? Great question. This is what I call the bull anomaly. Operationally, AMC is showing real strength. Avatar Fire and Ash opened to $345 million. Domestic weekends are hitting $88 million. The theaters are packed. The popcorn is selling. So why isn't the stock reflecting that success? Here's the kicker. 82.76% of AMC's trading volume is happening in dark pools. Non-transparent, off-exchange trading that completely neutralizes retail buy pressure. It's like trying to fill a bucket with a hole in the bottom. The operational success never translates to price action because the market structure is designed to suppress it. Even if that pressure somehow breaks through, there's a mathematical ceiling that makes any meaningful recovery nearly impossible. AMC has 1.1 billion authorized shares. Analysts at Citi and B. Riley have slashed price targets to as low as $1.30. But here's the part that makes no sense until you understand the game. Despite all the talk about shares being scarce and hard to borrow fees are sitting at a laughable 0.79% to 1.05%. That means institutional shorts aren't feeling any pain. There's no squeeze pressure, no urgency to cover. They can hold those positions indefinitely at virtually no cost while collecting premiums on the way down. And the risks go beyond just the balance sheet. We're looking at systemic exposure here. In a market where margin calls are increasing, AMC becomes a target for collateral liquidation. It's often the first position sold when institutional players need to stabilize their portfolios. Layer on top of that the industry-wide shift towards streaming, where companies like Warner Bros. Are pivoting away from theatrical releases, and you start to see the long-term cash flow for cinema chains facing permanent impairment. The entire business model is under siege. So after all the memes, all the headlines, all the box office records, what is this actually worth to you as a shareholder? Let's do the math. If you put $1,000 into AMC today and hold it over a 5-year horizon, the projected retail principal erosion could leave you with just $28.33. Let that sink in. Will AMC avoid bankruptcy? Probably. Management is doing everything they can to keep the lights on, but they're using your stock as the mechanism for debt restructuring. Until that $150 million at the market offering is exhausted and the 2026 debt wall is addressed, common equity remains subordinated. The company survives, but shareholder value is the cost of survival. Before we wrap up, I need to give you the standard disclaimer. Nothing in this video constitutes financial advice. I'm not a licensed financial advisor. This is purely educational content based on publicly available data and market analysis. You should always do your own research and consult with a qualified professional before making any investment decisions. Trading stocks carries significant risk, and you can lose money. So here's the bottom line. The range isn't breaking because it can't. The structure won't allow it. Operational wins don't translate to shareholder gains when the capital stack is inverted and dilution is constant. If you're in AMC hoping for a breakout, you're not fighting resistance levels, you're fighting mathematics. Thanks for watching, and I'll see you in the next one.